All right, guys, welcome back for another video. In today's video, I want to talk about the CPI data release targeted for tomorrow, August 10th. That data will be released early tomorrow morning around the New York Open. Now, I also want to make this video a little bit on the bigger picture, but first I'll just talk about CPI. From all the info I've seen, the expectations of the market is that CPI will come in around 8.7%. So if you see CPI come in closer to that 9% number above expectations, you can probably expect risk assets to sell off. And if you see that number come in closer to the 8.5% number, you can probably expect risk assets to catch a bid and get a little bit of a rally. But again, that's just very short-term price behavior, and it's important to understand the expectations that exist in the market and how reality interacts with those expectations. But I want to move on to the U.S. Treasury yield curve. And I've got the 2-year, the 10-year, and the 30-year yield curve all mapped out here. So this is the U.S. 2-year, 10-year, and 30-year Treasury yield. And you can see here that, these are all relatively rising, but the 2-year is rising faster than the 10-year and the 30-year. So what's really important here is the fact that the 2-year yield is at 3.272 and the 10-year yield is at 2.79. That's roughly a 50 basis point differential, negative differential. So the fact that the 2-year is trading 50 basis points higher than the 10-year is what you would call an inverted yield curve. The reason why it's inverted is because typically in a normal interest rate environment, you would expect longer duration bonds to yield more, right? Because after all, yields are the money value and time value of money as it relates to time. So that's why you would almost inherently expect higher yields from longer duration bonds. The fact that you don't see that and you see an inverted yield curve means that the yields in the monetary system no longer respects the boundaries of time and energy, which is pretty obvious considering the inflationary environment we live in. But it does make sense. I mean, the U.S. 2-year, it basically, as you get on the further durations, right, it just makes less and less sense to hold these bonds for a long period of time, considering that we're in an inflationary environment. And I think one thing worth mentioning is that, we're in a kind of a phase in the market where, the market generally thinks that, inflation is transitory, or at least they believed it was transitory for a time. Well, now we realize it's not transitory, but we still, a lot of people still think it's transitory in the sense that they believe that the Federal Reserve will stop it, right? That they'll keep raising interest rates until inflation goes away. And hopefully I can make the argument that inflation is never going away, right? It's not possible to reduce inflation, at least not with interest rate rises. All we can do with interest rate rises is reduce the rate of change. And that's very important, right? If CPI were to go from, say, 9% as it peaked in June down to an 8% number, that would not represent a decline in real prices, right? It's simply a decline in the rate of change of CPI. But of course, that's complicated and the public doesn't understand it. So what would probably happen is if you see a decline in the rate of change, the Federal Reserve would probably come out, declare victory, and say that they've done enough. When, of course, prices have continued to rise objectively at a significant rate. So again, that's very important to understand. Inflation is never going away because of the fiat system, right? All that changes is the rate of change. And ultimately, as if we're someone who owns risk on assets or, crypto being one of them, what we care about primarily is the rate of expansion of the monetary supply, not necessarily the cost of money as reflected in interest rates, right? So theoretically, you could print money and raise interest rates nominally at the same time while raising interest rates nominally, but still keeping real interest rates negative. So say, for example, inflation's rising dramatically, uh, you know, uh, 5% year over year. That's the rate of change. And you're raising interest rates nominally from a 0% bound. Well, and maybe 2% a year, right? So you're raising interest rates 2% a year, but inflation's rising at 5% a year. So your negative rates are actually, your real rate is declining by 3% a year in negative territory. So that's really important to understand the differential between the inflation rate and the nominal interest rate and what the real yield is. So that's a very important concept. You can see nominal interest rates rising as money is printing. And that's something that's happening in the Eurozone right now. Um, you've got the European Union buying southern member states' bonds. They've just unveiled that new program and also raising interest rates at the same time. So that's a great example of that type of dynamic. And in Italy, you see this a lot of the bonds that are really troublesome and outstanding are actually coming due to maturity in 2023, which means you know um, a lot of those bonds will need to be rolled over and refinanced, and that'll have to happen in the Eurozone through money printing. But I think a lot of people here are more concerned about when does the Federal Reserve uh, start printing money. I mean, I think that's what people care about. Well, when that happens is when there's an impairment in the bond market or an inability for the U.S. government to finance itself. So I'm going to talk about two of those separate ideas, and I'll start with the impairment in the bond market. So we already talked about the inverted yield curve on the 2-year and the 10-year. That always leads to a recession, but it doesn't happen immediately, right? It really grinds out the economy over time. Um, but one thing that would ultimately lead to an impairment in the bond market very quickly is if any of the Treasury yields ever dip below the federal funds rate. And the federal funds rate is the interest rate that the Federal Reserve sets on the FOMC meetings. And you can see this week the federal fund rate is at 2.5. So if you ever see the U.S. Treasury yields dip below this 2.5 federal funds rate number, that's going to cause extreme severe impairment in the bond market, and the Federal Reserve is going to pivot right away because otherwise the bond market's going to collapse. And the reason why that is because this 2.5 yield on the federal funds rate represents the yield floor that exists in the market. And the reason why it exists as a yield floor is because when the federal fund or the Federal Reserve sets these rates, basically what they're doing is they're opening the reverse repo market to large commercial banks who can park capital at the Federal Reserve with no counterparty risk at an annualized yield of 2.5%. Uh, and the reason why that's significant is because they have no collateral risk with that, right? They're not holding a bond that could fluctuate in value. They're just parking US dollars, cash at the Federal Reserve and getting this 2.5% yield with no counterparty risk because the Federal Reserve doesn't have credit risk, right? You inherently can't have credit risk if you're the Federal Reserve, right? They can't go insolvent, right? They can just print more money. It's not like you're loaning to another commercial bank where you have counterparty risk and that bank can go insolvent, right? So ultimately, that's just a long way of saying, this 2.5% represents the yield floor. And for multiple reasons, if you ever see the Treasury trade below there, that's going to be severe. So now in the September meeting, this will theoretically be raised to 3.25%. You know, I'm sure yields would rise in tandem. I mean, that's what you would expect, right? If you don't see yields rising in tandem or well above that, that well, first of all, if they don't rise above that 3.25 number in September, you're going to have immediate impairment. But what could happen is if, say, you see the Federal Reserve raise 0.75% on the federal funds rate going into September. And then you only see the 10-year, raised by 50 basis points, but the federal funds rate raised by 75 basis points. Well, the lagging of the yield would still put it above the federal funds rate, barely, but it still would be above. But that the fact that they would lag in that fashion would show you that I would interpret that as the market pricing in the risk of a recession, right? And that's a whole other, thing in itself. But I think the moral of the story here is that inflation's not going away. It's only going to get worse. And, it, and one way to put this in perspective is that, if every single cent of fiat currency in the world was channeled into paying debt, it wouldn't be enough to significantly reduce the debt. The debt burden is terminal, right? It's like, somebody who's got their terminal cancer diagnosis and they're going to die, right? And the only thing we can do is make their life more pleasant as they pass. The fiat markets are the same way. The U.S. government, if it keeps going on this course, will very quickly pay more in interest than it receives in tax receipts, and that is the point of no return, right? That's when you truly get into a debt spiral and things get out of control. But with foreign buyers of Treasury bonds on strike, the Fed will need to step in and backstop the Treasury market by buying bonds so that the government can keep its borrowing costs low and finance projects that will hopefully allow GDP to rise on a nominal basis. And what I mean by GDP rising on a nominal basis is that it's not going to keep pace with inflation, right? And interest rates may rise nominally as well. But if they do raise, they'll hopefully raise at a lesser basis than GDP rises as opposed to it, so that those debt to GDP ratios can be diminished. And that way that the government can run real negative rates over a long period of time and delever their balance sheet. Now, I also think that while the inverted yield curve does wear down the credit market over time and the outcome is certain, there is a little bit of doubt in the market about when exactly that will happen. I think, though, what you see is that bond investors are getting killed, right? The average duration holding period for a bond investor is now roughly 20 days. And that basically tells you that bonds are not being held by investors anymore, for good reason, because if you hold a bond to maturity, you will lose money in real terms. In real terms, right? If you account for inflation, you will lose money. So it's very unique in that sense. People are only trading this asset generally because it has a lot of liquidity, but investors are not holding it to maturity. And one thing also worth considering here is you think about well, if bonds are such an unfavorable investment, how does capital flow in there, and how does the Federal Reserve expect there to be a buyer in the bond market to support the U.S. government's cost of financing itself? Well, one thing that's interesting is that there's a lot of different regulations around banks controlling their reserve requirements, meaning that they have to collateralize some of their investments with Treasury bond purchases, and those Treasury bond purchases are in USD terms. So basically, the point of that is that if the value of that collateral drops significantly relative to some of their other investments, then they're legally required to buy more bonds, right? Or they'd be in violation of the the banking regulations. So that's the situation how if the value of a bond drops, you could have these major institutions who are legally required to be the bag holders for that. Um, you know, if those yields continue to rise and the value of the bond drops. Now, keep in mind that what we're looking at is the yield of the bond, right? Not the underlying value of the bond. As the yields go up, the bonds values go down. Again, that's a very basic distinction, but someone who's not familiar with the bond market may not know that. So that's just something to keep in mind. Yeah. Anyway, I hope you guys like this content. If you guys like this video, just leave a like below, subscribe to the channel, and I'll catch you guys in the next upload.